Welcome to episode 2 on how to get funded in 2024. In today's episode, we're going to be talking about the draw on liquidity. Because, quite frankly, my friend, if you don't know the draw on liquidity, then you are going to be the liquidity. Like my good friend Casper says, if you can't see the liquidity, then you are going to become the liquidity. And I can't tell you how true that is. Draw on liquidity, basically, in very simple terms, is going to be your prominent swing highs, like this, for example, and swing lows. Okay, this can be internal swing highs and swing lows, meaning you're in a range and you have little swing highs and little swing lows. That is going to be your internal liquidity, and your external liquidity is going to be your swing high and swing low that made that range that all these little swing highs and swing lows are in. Okay, it's very, very simple. I'll show you guys some examples from like today and even backtest with you guys, so that way you're not confused even with this sketch here. Now, liquidity is basically the profitable traders' short or long positions. It's where they put their stops at, and most of the time those stops are going to be found at the swing highs, above swing highs, or below swing lows. For example, I've sketched out a sketch here. Now you have a swing low and a swing high here, and you have internal liquidity as well, right? One thing I cannot stress enough is draw on liquidity to figure out where price is most likely going to go. You need speed, and you need displacement. Those two things are very key in trying to figure out where price is most likely going to go, whether it be on the lower time frame or the higher time frame. Okay, you need that speed and you need that displacement. Those two things are very key in trying to figure out where price is most likely going to go. Day trading is a game of probability, and we are all trying to figure out where price is most likely going to go. I know a lot of people say don't predict, react. Well, I have to go against that. You have to predict and you have to figure out where price is most likely going to go, because if you don't, like I said, you are going to become the liquidity. Okay, a lot of times when you see these swing highs and they stack up, like in this example here, there's going to be a lot of traders that are in profitable short positions. This is called buy side liquidity. Okay, when you have prominent swing highs like this stacked up, or even one by itself, that is called buy side liquidity. And price will basically draw to those stacked highs or that prominent swing high. Think of draw on liquidity like a magnet. Like price is going to be pulled to those prominent swing highs or stacked swing highs or swing lows. If I invert the chart, then you have stacked swing lows, which is sell side liquidity. Okay, like I said, guys, it's not very complicated. You just have to figure out where price is going to go. And how do you figure that out? Speed and displacement, making sure you have that speed and displacement on your side to then figure out, okay, price is probably most likely going to go to this low, which is sell side liquidity, or is going to go to that high, which is buy side liquidity. Okay, now one thing I cannot stress enough as well is you do not have to top tick anything. You don't have to buy the stops. This is a very advanced strategy that unfortunately I will not be teaching in this series. I'm going to be teaching you guys a very beginner friendly strategy, a very sort of advanced strategy as well, that you guys could implement into your trading in 2024 and hopefully get funded. That is my mission for this series. But nonetheless, you do not have to top tick. You do not have to bottom tick these trades. Okay. Once you have speed and displacement on your side, for example, here, price most likely draws back to a fair value gap, right? That is another form of draw on liquidity. Price is doing two things. It's seeking liquidity or it's seeking imbalances. And those two things are a form of draw on liquidity, okay? Liquidity and the draw on liquidity can be in the form of imbalances or fair value gaps, aka fair value gaps, okay? You don't have to bottom tick or top tick anything. You just wait for the speed and displacement and you wait for that fair value gap. And guess what? In this example here, in this little price leg, which is the internal liquidity, price is most likely going to draw to what? Sell side, right? Which is this swing low. Now you have the speed and displacement on your side. Price retraces back to that imbalance, which is drawing to that imbalance. There you could take a safe position, a safe short position, and draw or take profit at that swing low, which is the external liquidity, right? You get in here, you get out there. That's literally all you need. You don't need to top tick anything, okay? And after, say you take a trade here, you have to wait for some sort of reaction. Now, I'm going to go in depth later in an episode in this series on trying to figure out whether price is going to continue after a liquidity sweep or if it's going to reverse. Most of the time, if you guys are beginners or even intermediate students, I would suggest that you wait for some sort of reaction after price takes external liquidity. For this example, it's sell side. So I would wait for a reaction here. You get that reaction, you get this huge speed and displacement. And sometimes, guys, you guys will not find an entry here. Okay. And if you do, you would take profit at the internal liquidity, right? You would consider taking profit at these internal liquidity points, because most of the time, guys, you guys will see that price will get close to that external liquidity, which is this swing high right here of this range, and it'll reverse. Okay. That is to punish traders chasing this displacement up, right? Because if you find an entry down here before taking this first internal, then that's good. You can consider TPing there, and TPing there. Now, once you get relative equal highs formed here, that is a good catalyst on betting that price is going to go back up to those highs eventually, okay? Your job in this here, if it pulls back, is to find another good entry with good risk to reward. Don't worry, guys. I'm going to be teaching you guys everything about that later on in this series. This lesson is just drawing liquidity, right? What is drawing liquidity, etc. It's just think of it as a magnet pulling price to where it needs to go, okay? Which is in the form of swing highs and swing lows. Now we come back up, we fail to take these relative equal highs again. Now we're forming internal liquidity here. We take out that low, and maybe there's an imbalance here that you can get into, and now you get into it long position and you take out these profitable short position stops, right? Because traders or retail, whoever is shorting this, they're shorting AKA resistance, right? They'll have a box here and this is resistance. People or retail, people that are not familiar with the smart money concepts, will try to go short every time that price taps into their little box, their imaginary box that does nothing. Now, if you get into here, you're pretty much betting that price is going to go and attack these highs, which most of the time they do, right? And retail traders will place their stops above these three highs or above the stacked equal highs or equal lows, right? Now you get into it down here after price, comes up and you see that it's not taking those highs. It's coming back down one more time. Maybe there's a 5-minute fair value gap, whatever it is, right? You get into it and you place your stop you place your take profit right above these highs and it hits, and that's where you get out. Because most of the time when you have stacked equal highs like this, and maybe there's a higher time frame PD array, which is like just points of interest like fair value gaps, order blocks, breaker blocks, etc., price can reverse, right? Especially if we form some sort of equal lows or something. Maybe if we form something like this, if price went down a little lower, didn't take out that low, and you thought it was going to, you could look for shorts now, right? Now that you took the profitable short positions stops, right? All these traders are out of the market now. Now they don't want to short because we took liquidity, we took their stops, right? Now we're coming back down, we're consolidating around here. Now we have that speed and displacement right here in this leg. Now we have triple equal lows. Again, you guys don't have to top tick anything. These are advanced strategies. If you guys are trying to buy the stops, buy the buy stops, this is a very advanced strategy, okay? If you know how to do this, if you've mastered this, you don't need to watch this series, okay? I'm sorry, but that is a very advanced strategy. And now we've been consolidating. Now we have that speed and displacement here in this price leg. We fail to take these lows. And even if we do take the low, guys, even if we go something like this and we form relative equal lows like that, and then we start retracing, all you have to do is just find where price is drawing to. What imbalance is price drawing to? Think of it like a magnet again. And then you could take a safe with good risk management position here and aim for these relative equal lows. Sometimes you'll get stuff like this where you have stacked equal lows. It comes back up. This is a very good entry for a short position. You could place your stop at the recent high or up here if you want wiggle room, depending on your position sizing. Again, I'm going to go over risk management in a video later on in this series, but it's just simple like that, guys. It's trying to figure out where that speed and displacement is and then capitalizing and trying to figure out where price is most likely going to go. Because once you have that speed and displacement, then you have a pretty good idea most of the time on where price is going to go. And I'm going to show you an example of today. I actually caught a short by myself because I was waiting literally all day for speed and displacement. It was a very range bound day. It chopped a lot of traders up, and you guys maybe got chopped up today. I don't want to bore you guys showing you guys the price action for today, for this day at least, because it was horrible. It was just literally range bound. Market open was right here at this candle. There wasn't really anything going on. I didn't take any trades. Actually, I take that back. I did take an NQ short, but I got stopped out at break even. So I just decided to wait all day, literally. And I'll show you guys where I got in on a trade. Now we have a higher time frame sell side liquidity here. Like I said, guys, swing lows and swing highs, right? Swing low, we took out that liquidity overnight. And now we have one more left here on ES, right? Now, today's day there was news, and I was waiting for all the news, the high impact news at least. It was FOMC minutes, and I was waiting for that to come out. And it came out here at this candle. Now, that's why there was a bunch of volatility here, right? But as you guys could see here, we have a swing high here, right? 30 minutes in the market open. We have what? Relative equal highs, right, guys? Look, price looked like it was going to draw up to this swing high right here, right? But it didn't. It failed to do so. We came back down and we took out what? Internal liquidity, right? We swept that low. You guys see that there? Swept that low. News dropped. We swept that low, that internal low, and then we pushed up and attacked these relative equal highs. Now, you guys might look at this swing high here and say, okay, that might be the draw. Let's go to the 5 minute, right? This might be the draw on liquidity now since we took these relative equal highs, right? Now we have a swing low right here as well, right? This is the range low, range high. Now, guys, remember what I said. We have a range high and a range low. This high does not need to be taken technically, okay? We took out the relative equal highs. Traders that got into short positions here at market open, this is about 30 minutes in the market open, 35 minutes, they put their stops above this high, right? Traders from London session trailed their stops to this high once market open. It looked like it was reaching for that high, but it didn't. It failed to do so. So guess what? We made new lows, and price was seeking the higher time frame sell side liquidity, right? That swing low over here, all the way to the left. Now, from London session, once market open and we made this high and then we made new lows, traders that had profitable short positions trailed their stop to here, right? And now we were pushing up with displacement, speed and displacement here. We were pushing up, pushing up. We looked like we wanted that high, but we didn't, right? We came back down, news dropped. We took out the internal sell side liquidity. We came up, took out this relative equal highs. Now look what happens next. Boom, we come back down. Okay, we might form a fair value gap here. Now, like I said, guys, why didn't this work? Why didn't the fair value gap here work on the 5 minute? It looked like it was going to work, but why didn't it work? Because, like I said, guys, a lot of traders that went short in London session, right? And once New York opened here at 9:30, I'm Central Standard Time, so it's 8:30 for me. They see the new high that forms that makes new lows. So they're going to trail their stop from here to this high. Okay, so now they're out of their trades. They're all out. A lot of traders that had short positions in profit that had their stops here, they're all out now. Okay, now what's left? Profitable traders, profitable long traders that went long here, that had stops here, right? A lot of traders that went long anywhere in this price leg, they put their stops below this low. Now some of them are out. Some other long traders that have long positions have their stops here, and a lot of higher time frame swing traders maybe have their stops here. No, they do have their stops here because that's liquidity, right? Now, since a lot of profitable short positions got out here, once they trailed their stop to here, once price made new lows and they trailed their stops to this high and now they're out, the only net profitable positions in the market right now are long positions, right? Now we have relative equal lows right here. We have this low that looked like it was reaching for this swing low in the morning, and it failed to do so. We came up, failed to reach that high, and now we attacked that high, right? Let me go back to the 15-minute really quick. Now let me fast forward this. Boom. What is that? Candle closes like this. This is speed and displacement, ladies and gentlemen. That's what you want to see, okay? I usually trade on the 15 and 5-minute chart, but this is what you want to see. We take out liquidity. We have no body candle closure above it. We have the speed and displacement. Again, guys, you guys do not have to top tick anything, right? They're probably saving these highs for later, probably for tomorrow, okay? We have a higher time frame sell side liquidity level on like the 1 hour chart. It's a very higher time frame swing low. So that's what we're aiming for, right? That's where price looked like it wanted to reach to, right? Overnight, it came down. It failed to reach that higher time frame sell side liquidity. Our job is to wait for displacement and speed, which we're getting so now here later in the day. What is that, guys? Displacement and speed. That's literally what you guys have to wait for. It's literally a game of patience. Now, I see this and I'm like, okay, where is price most likely going to go? Let me delete these lines down here, right? We took out internal, but we still have that external low, right? And all this is relative equal lows, right? All this right here is relative equal lows, right? Price looked like it wanted to reach a little lower in the morning right here to take out that low. It failed to do so. We took out internal. Now we took out relative equal highs. Doesn't need to take out that high because traders that had short positions trailed their stop there. Now they're out, okay? Speed and displacement, ladies and gentlemen. Now let's go to the next 15-minute candle. Boom. Guess what? Now we leave another set of relative equal lows. And guess what? Now we have a potential candidate for another draw on liquidity in the form of a fair value gap. Okay. Price can draw up to these imbalances. That's another form of draw on liquidity if you guys did not know that. Okay. Come up, tap it. You could set a limit there, or you can get into a pretty safe position here, a short position, which could be something like this. Sorry, that's the long tool. It could be something like this, and you could place your stop at the candle's high that formed this fair value gap there. If you guys don't know what a fair value gap is, please go watch what a fair value gap is, because I'm not going to be explaining it in this video. This is a draw liquidity video. And some of you guys might be like, okay, risk to reward isn't that great. But let me tell you guys something. Once you see that displacement and speed, you guys don't need to worry about the risk and reward, okay? Because if you know where price is most likely going to go, especially when there is stacked relative equal lows or highs, it most likely will go there once you see that speed and displacement. So you can be very confident and have a lot of high conviction trades doing this. Once you see that speed and displacement and you see where price is most likely going to draw to, those trades are very, 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 very quick. Our job is to build conviction and confidence in our trading, in our probabilities, because trading is a game of probabilities. So draw on liquidity is the basis of all, it should be the basis of all your trade ideas, okay? You guys need to know where price is most likely going to go. I can't stress that enough. Anyways, see the speed and displacement, you see the imbalance there. You guys could go ahead and take a position there. And then bada bang, bada boom, you should be out all right there at the higher time frame sell side liquidity, which is this swing low right there. Hits it, okay? That's where price was drawing to, right? We have all these swing lows. It drew to every single low, okay? Same thing on the upside, right? We had all of this buy side, draws up to all of it, okay? Now we're on the sell side of the curve. Guys, draw on liquidity should not be complicated. It's literally that simple. Think of it as magnets at the swing highs and prominent swing lows, okay? It's literally very, very simple. It should not be complicated at all. Hope you guys enjoyed this video on draw on liquidity. I hope draw on liquidity makes a lot more sense to you guys. It's literally a magnet. All you need is speed and displacement to figure out where price is most likely going to go. And then you should be golden. So hope you guys enjoyed this video. I will catch you guys in the next episode, which I think is going to be the higher time frame narrative and how to form trade ideas off the higher time frames, which is very important. But I needed you guys to watch this video first to understand draw on liquidity. So catch you guys in the next episode. Hope you guys are enjoying this so far.